Hey everyone, welcome back to Corporate Decoder, the place where we translate all the financial jargon into plain English. And right now we have Chicago Atlantic BDC Inc. and their latest quarterly report. And let me tell you, this report is packed with more financial details than a tax accountant's lunchbox. Get ready. Because we're diving deep into their financial health, the good, the bad, and potentially the very interesting. And hey, if you love getting these straight-talking insights from SEC filings, make sure you are subscribed and join our growing community on Discord, linked in the description below. You do not want to miss those lively discussions. Alright, so this is Chicago Atlantic BDC Inc. filing their quarterly report, essentially giving us a snapshot of their financial situation as of the 30th of September 2025. Think of it like a progress report for the company. Let's start by looking at what they own and what they owe. On the asset side, their investments at fair value are the big ticket items, sitting at over $311 million. That is up from just over $275 million at the end of the previous year. They also have about $10 million in cash and equivalents. On the liabilities side, they have a revolving line of credit for $11 million. And various payable accounts for things like fees and expenses. What is really important here is total assets are around $327 million, while total liabilities are about $24 million. That leaves them with net assets of over $302 million. So far, so good. Now let's talk about how they made money and what they spent it on. For the 9 months ending the 30th of September 2025, their total investment income was a whopping $40 million. That is a huge jump from just $9 million in the same period last year. This massive increase in income is mainly from interest income, which went from $8.2 million last year to over $37 million this year. That's a jump of almost 350%. This huge surge in income is a direct result of their massive investment growth, which we will touch on again. On the expense side, things have also increased significantly. Income-based incentive fees shot up from $328,000 last year to over $6.2 million this period. They also nearly tripled their management fee expenses, going from $745,000 to over $4 million. Overall though, their net investment income still saw a dramatic increase, climbing to almost $25 million for the 9 months ending September 2025 compared to just $1.4 million last year. That's a phenomenal leap. Okay, let's get to the heart of the matter, their investments. For the 9 months ending the 30th of September 2025, their investment portfolio is valued at over $311 million. The vast majority of this, about 86.5%, is in first lien senior secured loans. They also have nearly $40 million in senior secured notes, which is about 12.5% of their portfolio. Notably, their investments are heavily concentrated in the cannabis industry, making up about 75.5% of their portfolio by fair value. That's a bold bet on one sector, and while it can pay off big, it also carries significant risk. It means if the cannabis industry hits a rough patch, Chicago Atlantic BDC will be feeling it. Their next biggest sector is finance and insurance at 9%. Looking at specific cannabis companies, they have a 16.9% investment in Verano Holdings Corp. On a first lien senior secured term loan, which is valued at over $42 million, that's a big chunk of their portfolio concentrated in one company. They also show significant exposure to Dreamfield's brands IncDB Agita, with an investment of over $31 million. This concentration shows their strategy is heavily focused on the cannabis ecosystem. In finance and insurance, they hold a senior secured note with RTCP LLC valued at $22 million, which is about 7.3% of their total investments. Then there is West Creek Financial Holdings Incorporated DBA Coalafi with a series of senior note valued at over $5 million. It is interesting to note they also have investments outside the US, with about $3 million in Canadian debt investments. Now let's talk about how they rate the health of their loans. As of the 30th of September 2025, a staggering 99.2% of their investments are rated Grade 2. According to their description, Grade 2 means the investment is performing in line with expectations with neutral or favorable risk factors. This suggests that management feels pretty confident about the current health of their loan portfolio. They have about 0.8% in Grade 3 investments, which means the borrower is performing below expectations, but capital impairment is not anticipated. 0% in Grade 4 or 5 ratings is a good sign, indicating no anticipated losses at this moment. Here is a crucial piece of information. When we look at how they value their investments, nearly all of them, 100% as a matter of fact, are categorized as level 3 under the fair value hierarchy. This tells us that none of their investments have readily available market prices in active markets. Instead, their fair value is determined using significant unobservable inputs. meaning management has to make a lot of educated guesses based on their own models and assumptions. This is where a lot of the risk lies in valuing a portfolio like this. The report also states that for these level 3 investments, the unobservable input is the discount rate, which ranges from 8.40% to 29.63% for first lien senior secured loans. This wide range highlights the subjective nature of these valuations. Looking at their debt on the 11th of February 2025, they secured a substantial revolving line of credit for up to $100 million, with $11 million drawn as of September 2025. This gives them access to capital to fund new investments or manage their operations. Borrowings under this line are at a floating rate tied to SOFR plus a margin, with a minimum rate of 6%. This means their interest expense will go up if interest rates rise. Let's look at a key ratio, the ratio of net investment income to average net assets for the 9 months ending September 2025. This ratio is a very healthy 8.23%. This indicates they are generating a good return on their assets. Compare that to just 1.72% for the same period last year, and you can see how much their performance has improved, largely due to the new investments. And boy, have they been active for the 9 months ending September 2025. They purchased over $124 million in new investments. They also had proceeds from sales and repayments totaling over $92 million. This shows a lot of portfolio activity. Now, let's talk about the risks. They are upfront about the risks of using leverage. Their credit facility pledges all or significant amounts of their assets as collateral. If they default, the lenders could seize those assets, potentially forcing them to sell investments at unfavorable prices and hurting their ability to pay dividends. This is a standard risk for any company using borrowed money, but it is worth noting given the amount of leverage they are employing. They also highlight the significant risk associated with their focus on the cannabis industry. They lay it all out there, the speculative nature, the federal legality issues in the US, the potential for changes in government policy, and the difficulty in obtaining traditional banking services. They even mention that as of September 2025, 3 portfolio companies represented 34.2% of their investments. That is a lot of eggs in a few baskets, and all those baskets are in the cannabis industry. So what is the story here? Chicago Atlantic BDC Inc. has seen explosive growth in their investment portfolio, driven by a big acquisition and significant new investments, especially in the cannabis sector. Their income has surged, and they're generating a good, if not great, return on their assets. The fact that most of their loans are rated grade 2 gives confidence, but the heavy reliance on level 3 valuations and the concentration in the cannabis industry are definite red flags. They are essentially betting big on a high growth, but also high risk industry. So while the financial numbers look impressive now, investors need to be aware of the inherent volatility and regulatory risks associated with their strategy. Alright, that is our breakdown of Chicago Atlantic BDC Inc. Its latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord in the description. It is the best place to continue the conversation. Thanks for watching. See you next time.